Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at IREN.
And if you find our talks useful, please consider subscribing, liking, and commenting underneath. We really do appreciate the support.
Okay, so IREN. This is a fascinating story.
It really is. We're looking at a company trying to pull off one of the most dramatic corporate pivots I think we've seen in years.
For sure. They're trying to turn a volatile Bitcoin mining operation into an indispensable AI infrastructure powerhouse.
And that's our mission today. We've gone through all the research, and we need to figure out if this is a genuinely genius strategic shift or, just a lot of hype riding the AI wave.
It's such a great case study because the story really does hinge entirely on execution. You're moving from the world of crypto, which is, cyclical and commodity-driven,
Right.
to the high-growth, contracted world of enterprise AI cloud services. It's a massive gamble.
But the payoff, if they get it right, could be just transformative.
Absolutely.
Okay, let's unpack this transformation then, because the foundation for this pivot is what really sets it apart for me. This isn't a story of desperation.
No, not at all. And that is absolutely crucial for you to understand. The legacy Bitcoin mining business was successful enough to basically pay for its own funeral and fund the new AI business.
That's a good way to put it.
I mean, fiscal year 2025 was fantastic for them. Revenue surged 168% to $501 million.
And they flipped to a profit, right?
Yep. Flipped their net income to a profitable $86.9 million, moving away from the losses they had the year before. This cash-rich old business is the foundations of what's letting them afford this really aggressive AI expansion.
So that's the setup. But the first quarter of fiscal 26 is where it gets really interesting. That's what validates the whole shift.
It wasn't just good, it was explosive.
Tell us about the numbers.
Revenue surged 355% year over year to $240.3 million, and net income hit an absolute record of $384.6 million.
Wow, that's not just incremental growth, that's exponential.
Exactly. And the market's attention really snapped to them because of the earnings per share. They completely obliterated analyst expectations.
What was the beat?
They delivered $1.08 per share versus the $1.15 it was expected.
That's a 620% beat?
A 620% beat driven entirely by this accelerating AI cloud demand. That single earnings report was the point where the street started to reevaluate them, not as a crypto proxy, but as a legitimate AI play.
But you need more than one good quarter. The shift from speculative momentum to a real structural business happens when you lock in revenue.
And that's where the contractual proof comes in. This is what anchors the entire pivot. We're talking massive multi-year contracts.
Which gives them that future revenue visibility.
The key takeaway here is stability. They moved from volatile, cyclical Bitcoin revenue to contracted, blue-chip enterprise annual recurring revenue, ARR.
The gold standard for infrastructure companies.
It's the gold standard. It means guaranteed contractual money coming in the door. The headline contract is the $9.7 billion 5-year AI cloud agreement with Microsoft.
Just that one deal is enormous.
It is. And to fulfill it, they had to secure their hardware supply. So they have a separate $5.8 billion deal with Dell for Nvidia chips.
Let me just put that Microsoft contract in context for you. That single agreement, $9.7 billion, is worth nearly 20 times the size of their entire profitable mining revenue from last year.
Yeah.
That's not a pivot. That is a complete overhaul of the business model.
And the targets reflect that ambition. Management is targeting over $500 million in ARR just from the AI cloud business by early 2026.
And that's just the start.
Right. The guidance suggests they could ramp up to as much as $3.4 billion in ARR by the end of 2026. If they hit those numbers, they are no longer the same company. It's an inflection point.
Okay, but achieving those targets requires more than just money. You need infrastructure, you need a defense. What's IREN's competitive moat here? Why them?
It really comes down to vertical integration.
Meaning they own everything.
They own the full infrastructure stack. They have the power contracts, the land, the substations, the data centers, everything. This allows for, superior cost control, margin expansion, reliability.
Compared to competitors who have to rent space or power.
Exactly. They control their own destiny and, crucially, their costs.
And the most critical part of that destiny is power. The amount of electricity AI training requires is just staggering.
This is their true structural moat in the current market. They have 810 megawatts operational right now, but they have secured a staggering 3 gigawatts. That's 3,000 megawatts of capacity in the pipeline.
And securing that much low-cost power, especially when all the major AI hubs are becoming power constrained, that's their real proprietary asset.
It is. And on top of that, their facilities run on 100% renewable energy. This is vital. Giants like Microsoft, what we call the hyperscalers, they won't sign these huge multi-year deals unless their partners meet really stringent ESG compliance standards.
So the power is the backbone. What's the secondary layer of defense?
The partnerships. We mentioned Dell for hardware, but the most strategic relationship is their preferred partner status with Nvidia.
Which is huge right now.
It's everything. The biggest constraint for anyone building AI infrastructure isn't money. It's getting an allocation of those high-demand Nvidia GPUs. By having preferred status, IREN significantly mitigates that supply chain risk.
So they can actually get the chips they need to fulfill that $9 billion contract.
They can. It's a very clever system. Secured power, guaranteed hardware pipeline, and high-margin contracts ready to go.
And all while generating cash flow through that dual-engine model.
Right. The way to think about it is that the profitable Bitcoin mining is the internal cash flow engine. It's paying the bills right now. It's essentially funding the massive AI build-out, the real long-term growth driver with internally generated capital.
It's an ideal hybrid model for a company in transition.
It is. They can monetize the exact same power infrastructure through two different streams.
Okay, so let's pivot to the capital required. Scaling AI isn't cheap. They needed to secure major funding to get this capacity up and running quickly.
They absolutely did. They recently raised approximately $3.9 billion. This is done through a $2.3 billion convertible note and a $1.6 billion equity offering.
But let's be real. $3.9 billion is a massive capital raise. Aren't shareholders right to be concerned about that kind of dilution?
That's the critical debate you see everywhere. But the sources we looked at largely view the move as, well, necessary and proactive.
Proactive how?
The capital raises essentially de-risk the execution. Management secured the funding before fully embarking on the build-out. It insulates them from rising equipment costs or market volatility.
So they took a short-term dilution hit to de-risk the long-term multi-billion-dollar opportunity.
Precisely. And we also see that all their free cash flow, which was almost $246 million in fiscal 25, is being reinvested right back into these data centers.
No dividends, no buybacks.
None. The focus is purely ruthlessly on scaling capacity to capture this growth.
This focus on execution brings us to the near-term catalyst. If you're watching this stock, there's one date you have to have circled.
For sure. The most critical near-term catalyst is the Q2 fiscal year 2026 earnings report. It's scheduled for February 11th, 2026. This is the market's decision point.
And what are analysts going to be watching for on that day specifically?
Clarity on capital deployment is number one. We need to see concrete progress on the AI ARR ramp, moving them toward that early $500 million target.
They need to show it's real.
They need to show it's real. And, critically, execution updates on the Microsoft contract. Are the GPUs deployed? Are the data centers online? Positive updates there will be a major swing factor.
And the macro environment seems pretty supportive of this narrative.
Absolutely. You have continued AI sector rotation, where capital is just funneling into infrastructure providers. Plus, expectations for future rate cuts always favor high-growth companies like this. The tailwinds are at their back.
Moving to technicals, we have to talk about volatility. This is not a boring stock. Its beta is over 4.
Yeah, that extreme volatility is what you get when you combine crypto exposure with hyper-growth AI speculation. But the price action is important.
It's pulled back recently.
It pulled back about 5.5% after a decent run.
Yeah.
But this is largely interpreted by analysts not as a structural failure, there is healthy profit-taking, a consolidation phase.
So this dip is actually seen as a buying opportunity.
Precisely. An attractive buy-the-dip entry point, especially since the price remains firmly above the 200-day moving average.
Which signals the long-term bullish trend is still intact.
Totally intact. Analysts note that key structural support is holding firmly in the high 30s to low 40s range.
And it seems like institutional conviction backs that up.
It does. Institutional ownership is at a significant 41.08%. We're seeing cluster buying, with firms like Farther Finance Advisors adding large blocks of shares.
I did see some big names were trimming, though.
Right, Paul Tudor Jones trimmed his stake, but that's generally viewed as just disciplined profit-taking after the massive run. The core AI story is still completely intact in their view.
Okay, let's talk price targets. The bullish narrative is strong, so what's the implied upside?
The consensus rating is a moderate buy. The average price target is clustered pretty robustly between, let's see, $67.64 and $69.85.
So that's implying a 50 to 60% upside from current levels.
Correct. But there's a wide dispersion in those targets, and that's important.
It highlights the execution risk debate, right?
Exactly. The aggressive bulls, like Cantor Fitzgerald at $100 and H.C. Wainwright at $80, are pricing in near-perfect execution. But you have to acknowledge the bears, like J.P. Morgan with their underweight rating and a $24 target.
That wide gap really shows the uncertainty.
It does. The market is assigning a huge range of probabilities to IREN's ability to deliver.
Which brings us squarely to the bear case. The bull story is incredible, but where could this all fall apart?
The absolute biggest threat is execution risk and the potential funding gap. Building out multi-billion-dollar GPU cloud capacity on time and on budget is incredibly difficult.
And any delays could be catastrophic.
Catastrophic. And even after raising $3.9 billion, analysts still worry about a funding gap.
Really? How so?
Well, the concern is that if execution falters, or if the cost of GPUs keeps climbing faster than they projected, that gap could require further dilution. And if they fail to deliver on that contract ramp, the stock faces a swift correction.
And the second risk is the valuation.
Correct. The valuation is high. The price-to-sales ratio is around 24x. That multiple is entirely dependent on them hitting those projected AI revenue numbers in 26 and 27.
Not on their current cash flow.
Not at all. If AI sentiment cools even slightly, or if they miss that first $500 million ARR target, that 24x multiple could contract to single digits overnight.
And we can't forget about Bitcoin.
Exactly. A sharp crypto market decline wouldn't kill the AI story, but it would create short-term earnings pressure and affect their liquidity right when they're trying to scale.
So wrapping this all up, what's the final investment thesis? Is the upside worth the risk?
The overwhelming consensus across the sources is that IREN offers an asymmetric risk-reward opportunity. If management executes, the competitive moats, the Microsoft contract, the 3GW of power, the Nvidia partnership should lead to a massive re-rating.
From a volatile crypto proxy to a stable, high-growth AI data center platform.
Precisely. The sources we looked at assign a high-conviction bullish score somewhere in the 7.5 to 8.5 out of 10 range. This is viewed as a high-conviction growth play.
And what's the recommended time horizon here?
This is not a quick trade. It's recommended as a multi-year hold, 12 to 24 months, to really capture the full AI revenue inflection.
With one key date to watch.
With that February 11, 2026 earnings report serving as a critical decision point. You have to use that catalyst to assess if management is really delivering.
Okay, final thought then. IREN's pivot hinges on delivering infrastructure, but its most proprietary, indispensable asset is power. Given that almost all major global AI hubs are becoming severely power constrained, we have to ask, does IREN's secured 3GW capacity make it less of a tech company and more of an indispensable AI utility for the hyperscalers? That shift in perception from growth stock to essential resource provider could unlock a valuation multiple far beyond what we are seeing today.